The Fed has done their job in the United States of breaking the back of rising inflation.
That's Karen Harris, the managing director of Bain's Macro Trends Group. The last time Karen was on the show, we discussed a wide range of potential outcomes for the global economy, from a severe recession to a soft landing. But over the past 3 months, the range of outcomes has narrowed. Hardly anyone is talking about a soft landing these days.
There's no more bickering about will the Fed raise rates or not. There's no more bickering about is there a slowdown. It's not good news, it's steadier news. And I think most of the businesses that we're talking to have a pretty good sense of where headwinds are coming now. It's just a matter of pulling out those playbooks and planning through 2024.
Today on Dry Powder, Karen and I will discuss the implications of a global recession and whether the emerging consensus will bring some clarity to central bank policies and deal markets. I'm Hugh MacArthur, chairman of Bain's Global Private Equity Practice, and this is Dry Powder. Karen, thanks very much for coming on the show today. I think we've got a lot of interested listeners to learn more about what's going on in the big wide world of macro. And in my mind, the only word I can think of is weird to describe the macro conditions, because I'm not actually an economist the way you are. But the weirdness for me is that we have a lot of unprecedented things that are mixing together. Some of them are negative signs, some of them are positive signs. We have unemployment at 50-year lows. We have people that have got a lot of home equity financed at very low interest rates for the future. We have $1 trillion of excess money slushing around the economy still and in people's bank accounts from COVID relief. There's just things going on that are pushing against what seems to be a move toward a recession. And then there are some other factors like the interest rates and worries over commercial real estate and things like that that get you more concerned. But help us come up to speed here a little bit. When you see these major economic developments of the last few months, how do you read those tea leaves and put it all together?
So we're unwinding from this bizarrely rapid business cycle. We created the downturn from COVID lockdowns, and then we created the upturn by letting people out. And we worked through the supply chain challenges that were generated from that. We then had Russia's invasion of Ukraine, plus energy prices already rising, and then a spike from that war. So as you say, this one is a pretty weird mix. There isn't really a better word for that. And so we need to unpack these different factors almost in phases. So there was the supply-driven tranche of inflation. There was consumer demand that drove a different tranche of inflation. It's always the balance between those two. And then what we've seen is almost profit-driven inflation, where businesses were able to push price because we were all confused about different factors, labor shortages, supply shortages. There was a tolerance for that price pushing, especially in the US, where consumers had been given household support. And all of those things are unwinding now. Of course, the biggest plot twist in this particular business cycle has been this incredibly fast torque of rising interest rates. For decades, buy the dip was the right strategy. And if we think about 2008 and 2020, we're 2 for 2 on central banks essentially coming in, intervening. Yes, we had a correction, but through liquidity, those markets came back. In 2008, it was by 2009 that we already saw some recovery. In 2020, it took 6 weeks. It's incredibly fast. And I think the belief that that could happen again hasn't quite dissipated. But what's changed is we are in a structurally more inflationary world, and we don't believe that central banks are going to come in and rescue asset prices in a downturn, and that there's still correction left to go. And I think the intuition that there's a floor under that because of policy is probably misguided this time.
Well, certainly one of the unintended consequences of the rapid increase in interest rates was the collapse of Silicon Valley Bank, which started a crisis of confidence in regional banking in the United States. Obviously, there were issues with Credit Suisse and banks in Europe as well. And as you well know, leverage is kind of the currency of doing leverage buyouts. And so having the banks be nervous and step back from making leveraged loans has really impacted the deal markets quite substantially. In your view, what are the implications of the Silicon Valley Bank collapse and the ensuing crisis of confidence around the regional banking system in the US?
Hugh, you and I have been talking about why we thought interest rates would go up in the first part of this decade before COVID for structural reasons.
Mm-hmm.
Even if you could see that coming, it's very easy to underestimate how quickly interest rates changed. It's the old cliche about the interest rates went down like an escalator and up like an elevator. And so the liquidity difficulties that these institutions ran into, what it points to for our team is less weakness in the regional banks of the United States. Yes, there's always a layer of mistake or mismanagement that one can point to, but the Fed knows how to resolve bank failures. They happen a lot more than the public sees. Usually, a bank gets closed Friday afternoon, its assets are sold over the weekend. Monday morning, deposit holders are told you're now a customer of Bank of MacArthur, and yay, we're moving on. But we're more worried about what's happening across the entire financial sector. I think it would be a tough bet to say 5 institutions got caught flat-footed as interest rates turn and everyone else is perfectly calibrated to that new interest rate environment and won't have any balance sheet or liquidity issues. And so that's why we keep on the table the possibility of a bigger recession than the market might see right now.
And do you think the Fed can handle that, though? Are we in a situation where we could really have a banking crisis on the scale of 2008 or 2009? Or is the financial system much stronger now because of the results of regulation and people just being smarter, once burned, twice learned kind of thing? Obviously, the rate of increase of the interest rates was really the problem here for Silicon Valley and a lot of other banks facing this. And yet, because I have a duration issues, right? I have demand deposits, which are on demand on the one side that are liabilities for banks. On the other side, I've been investing in longer term treasury securities and other things like that to try and pay out a decent interest rate and get a better rate for those depositors. And when interest rates go way up, the value of my investments go way down, and I suddenly have a liquidity crisis. Short sellers can come in, and boom, you've got a banking crisis and some collapses. Is that something we should be prepared to see? And can the Fed really resolve that? Or do you think that the Fed can preemptively do something to prevent this type of banking crisis from continuing or becoming a major issue?
So the banking system itself, I think, is the more easily resolvable piece. There are certainly consequences to the increasing concentration of the US banking system, but they aren't likely to be cascading failures, right? I don't think anyone thinks JP Morgan is at risk as an institution. The risks of the domino effect sit likely outside that traditional banking sector. We don't know what institutional investors have high concentration of bets in commercial real estate, for example. We can see that those valuations are under stress. And will there be an institution that has a liquidity event that makes them have to mark to market? And does the Fed miscalculate the size of that particular failure? So, to your question, these risks sit out there. It's always a miscalculation, a management failure, plus unanticipated size. And of course, that could still happen.
So it feels like we're in a period, to steal a phrase, of watchful waiting as far as the banking system goes, but potentially a more hopeful outcome than what we saw in '08 and '09. There could be wobbles at the edges, which tell me that banks will remain conservative in their lending. Obviously, if you're leveraged at 10 or 12 to 1, like a commercial bank, you're going to be careful with leveraged loans. But there is a scenario where we don't see real breakage in the banking system as a result of the rapid rise in interest rates.
Yeah, absolutely. I mean, will some institutions fail? Sure. Have some investors made bad bets? Absolutely. The distance between that and a catastrophic financial system led downturn is massive.
So if you were to put that investor hat on and you were in the private equity markets today, is it safe to assume that we're actually in a recession now? Is that what would be your ongoing assumption? The recession is kind of here and that interest rates therefore will stabilize? Or do you think that the recession is somewhere down the road and we have a lot more interest rate increases on the horizon?
Our view is that in the US, we've broken inflation. We're past peak. In fact, if you look at the core of core inflation, which it sounds a bit silly, but you take out food and energy, which gets you to the core inflation, and then you take out automobiles because that has been such a distorted sector during this last period, and take out housing because of the lagged way we impute the cost of housing into CPI. We're actually at inflation that's back to 2019 levels and below. I know it runs the risk of comically removing everything that doesn't sit within that story. But I do think it's worth watching each of those in their own way, because we know, again, rent is not forward looking. So that's really important as we think about where rates could go going forward. And so the Fed has done their job in the United States of breaking the back of rising inflation. Is it collectively where they want it to be at 2% target, or where they need it to be for credibility? Not yet. But as the momentum, as it's heading in that direction, there isn't a lot of data that would tell them they need to raise interest rates more. So I think the consensus that we can rest here is right. I do worry about the idea that we will somehow lower rates, which is built into some of the yield curve. That seems a little too soon. It imputes, again, that the Fed, that they will declare victory here at 4+% as opposed to being serious about getting back down to 2%. And I think that's a risky bet to make. I think they've been pretty clear that they're serious about that. So there's runway to pause, if not to raise, in the US.
So obviously, a lot of these macro developments have created uncertainty, which I, in many instances, call the U word. It's a kind of a dirty word in private equity investing, because uncertainty makes you want to stop by definition when you're trying to forecast out performance over 5 years and then apply leverage to an investment decision. That makes it very challenging to be uncertain about these big macro shifts that we're talking about. How do you determine whether and when we're going to be on the verge of a turnaround in deal making? Are there early indicators to investors should be watching in the months ahead to say, okay, it's safe to put my toes back in the water or just jump back into the pool entirely?
I think that's where we need to look through some of the structural forces that will help guide us through this next cycle. The most important one, and the one we've talked about quite a bit, is what we call post-globalization. There's a lot of conversations about trade barriers and goods and what that means for the US, China, and Europe. But what we don't hear a lot of discussions about, it's the demand for savings versus the supply for savings, because savings equals investment. The demand for savings with reshoring, supply chain rerouting, service sector automation. On the supply of savings, there's this demographic transition, right? This baby boomer saver group moving into retirement, and less free movement of capital to regulations based on this post-globalization and different framework. If you look at those two forces, we're going to be in a higher rate environment. How high depends on central bank policy and how much they want to suppress inflation that comes from that. If they want zero inflation, real rates will be higher. If they decide after hitting 2% that they can live with 3% inflation, nominal rates are higher and real rates are lower. But for investors, they need to get used to that idea and reprice. And of course, you know this, and I'd love your point of view, but I suspect that part of the challenge right now, it's a sort of a reflection of what we see in the housing market, is people don't want to sell at prices commensurate with a structurally higher interest rate environment. So the owners of the assets would rather wait it out than sell too cheaply now, trying to estimate where those land. And I think it's that repricing that is the hurdle to seeing it, that along with capital is the hurdle to seeing revived deals. But I don't know, does that resonate with you, Hugh?
Yes, it does. I mean, I think the number one thing to get things rolling in terms of deal making is really having buyers and sellers agree, of businesses as well as houses, agree on notions of value. And I think that will come back as some of these macro factors that you're describing stabilize. If people know that interest rates are going to roughly be within a band, you understand how to put together a model and finance a deal. Interest rates right now are not absolutely high. They're kind of 2007-ish levels. We did lots of LBOs in 2007. So it's not that the industry can't handle a higher interest rate structure. It just wants to understand, is this it? Or are we going to have interest rates go up an awful lot more and I'm going to have to deal with potentially refinancing in a much less attractive market? So I think having people feel like we're kind of reaching that point in interest rates, or we're within the zone, if you will, of where interest rates are going to be and roughly where inflation is going to be, will be important, because that will allow buyers and sellers to say, okay, this is the environment we're dealing with. This is roughly where GDP is. We get it. We can actually agree on a price for an asset and then move forward. And then I think the big thing for me that I'd be watching for if I was an investor is, when is a commercial bank going to make a loan that supports that notion of value between buyers and sellers and that deal model? Because once the commercial banks get back into lending in any type of way, I think the floodgates will open. We've obviously got over $3.7 trillion of dry powder out there for private asset classes of all kinds, and $1 trillion of that is for buyouts alone. And of course, that is a time-based commitment, and GPs want to put that money to work. So the incentive to get to an agreed price and get to something sensible on the part of buyers and sellers is quite strong. It's when the banks step up and say, okay, we're in. We're going to do some leverage lending now and get back into that business. To me, that's the domino that will really unlock a lot of demand and a lot of deal making going forward.
You just said a lot of really important things, but one I think is that central banks have chosen to allow inflation to run hot in some ways as a consequence of this global integration that we've had since the 1990s. But that doesn't have to happen going forward. The more inflationary the world, the more central banks actually have the ability to suppress that down to zero. Now, we can have all sorts of discussions about whether we can pay debts in a zero, do you want to monetize the debt, and what the right policy is going forward. But I do think it's important to distinguish that is still a jump ball about what the posted inflation rate could and would be. And there's a wider range of potential outcomes there than we saw before. The impact of that on investors is, let's not underestimate where real rates could stabilize, which points to a different return on capital profile for investments than it might have in a lower real rate or a negative real rate environment, which is the ones we've just been through.
Right. So certainly the threat of lower returns is out there without being able to manage real inflation at a different historical rate going forward than what investors might have been used to in the past. On the next episode of Dry Powder, Karen and I will discuss de-dollarization and whether investors should plan for a world of multiple reserve currencies.
In our view, globalization is fading into what we call a post-globalization world. Then it logically follows that the financial system, this dollar system, would fade along with it.
I'm Hugh MacArthur. Thank you for listening.